the credit to collections domain. She's going to kick us off here. But the agenda today is going to focus on data enhancements, score enhancements, platform enhancements, and we'll discuss what's next. So without further ado, I'm going to turn it over to Ms. Rhonda Burris. Rhonda, if you want to take us away.
I appreciate it. Thank you, Chris. Appreciate everyone's time this afternoon as we discuss some of the data enhancements and score enhancements that we've been working on here at Dun Bradstreet. Obviously, the last 18 months have called for us to be very rapid in our responses to our clients and their needs for more data. We already have, obviously, the world's largest commercial database, but we found quickly in February of 2020 that we needed to expand our data sets and what we have basically that comprise our database, make it more available to people, because frankly, 2020 was just a whirlwind of change. So if you'll move to the next slide for me, Chris, the big thing that we were hearing from our clients was we need more information and we need it now. I think, speaking as, again, a former credit practitioner myself, the demand for ad hoc reporting and internal interdepartmental reporting that was placed on credit and finance operations in Q1 of last year and Q2 was at levels, frankly, that we hadn't seen before, because everyone was asking questions of, and rightfully so, in their organizations about what does our cash flow look like? What are we seeing a dip in collections? Are customers' doors closed and we can't service them because they're physically not there anymore? What about our supply chain? Are we getting our products to people so that we can continue to drive sales? All of these things basically were hyper-focused in 2020 at, I'm sure, at your organization's level, but certainly here at D&B, those were the type of requests that we were hearing, and certainly the type of information that we were trying to put out there to make more available for folks. So cash flow analytics, being able to determine if it was for example, a temporary change in collection habits, or if this was a more permanent issue that companies would need to adapt for. Driving sales into new markets. If I'm going to increase cash flow, I only have two ways to do it. It's increasing collections or increasing sales. And being able to provide data interdepartmentally again, for a lot of our clients, became a real challenge last year. So if we move to the next slide, one of the things that we had to account for and adjust quickly on our side, even at D&B, was recognizing that we were looking for answers in risk that frankly had hidden risk sublayers underneath them. So it wasn't enough to know, for example, if a potential new customer could pay their bill on time. It became important to know, where did that customer come from? What vendor did they use previously? Who owns that particular entity? Is that owner involved in any previous relationship we had? Another one that was a kind of big surprise for us was a request to know when customers were also suppliers. We found a lot of clients that had multi-tiered relationships within their business, where the supplier was also a client and where the client was also a supplier, and being able to see those holistic relationships throughout the company became a key focus. And then, of course, underlying all of that, then, what local and regulatory requirements did that industry have as a result of what was going on in 2020 at the economic scale? What changes to business practices had to be met? What shipping delays might have occurred? All of those sub layers of risk really started to come up to the surface in 2020. And so if we move to the next slide.
Yeah, Rhonda, I don't mean to interrupt, but I think it's important to highlight a couple of things that you touched on. When we look below the iceberg here, under the water, we start to see things that would typically be found in supplier onboarding exercises, whether it's regulatory risk, beneficial ownership, some of the new things, terms that are out there in the marketplace, ESG, environmental, social, and corporate governance, things around sustainability, fraud, certainly. So I'd encourage everyone to, as we go through the next several slides, you'll find that D&B is bringing to light a lot of analytics that might not have historically been part of what the credit practitioner would look to leverage. But with the impetus of COVID, we find that these business interactions, and that's really what they are, we're moving away from a model of customer supplier and more just KYC around business and business interactions in general. And I know, Rhonda, you'll be commenting on that a few
Mhm.
slides from now. But one that's just sort of linger in the back of everyone's mind, this where we're seeing this move away from traditional credit and finance due diligence. Not that we're abandoning it, but we're going to be incorporating these new analytics, and they're derived from a lot of the data that we capture, and quite honestly, a lot of questions that we're fielding from our clients. So I'll let you have it again, Rhonda. Let me move
Mhm.
to the slide here. I apologize. There we go. So whole question, everyone, and sorry for that transition, but appreciate everyone responding here. We'll give it a few seconds. As a result of COVID, which areas of your finance organization have instituted a policy change or expanded reporting? Please feel free to choose all that apply. We'll give it a moment here. I imagine, and Rhonda, you as a practitioner, had we been operating in our practitioner roles, I'm sure we would have
Mhm.
been looking at things like policies, processes, onboarding exercises, even looking for new revenue streams in light of a pandemic.
Absolutely. I think, and for me, coming out of oil and gas, if you'll remember Q1, Q2 2020, the price per barrel was a real roller coaster ride. So people in that particular industry, for example, all of a sudden credit limits bought you, 500 times more than you were actually willing to give credit for. So yeah, I was very happy actually not to be a practitioner last year and to be an observer, an interested observer, but
Yeah, yeah,
definitely,
yeah. Well, hey, look,
definitely
I
felt
remember
that.
I remember when gas was, 91 cents a gallon. I welcome those days. But that being said, we have some of the results in. Appreciate everyone responding. Look, collections and cash forecasting, 70% of respondents, this is an area where there's been a policy change. Absolutely. I think that that's a legitimate concern, obviously turning the receivables over as quickly and accurately as possible, having that impact on working capital and cash flow. But it looks like, there's been activity in every area. Customer onboarding, certainly. Obviously, we need that. Again, talking about KYC, know who you're engaging in business with, credit limit evaluation and assignment. How do I proactively address that? And then, of course, loss reserve. Everything, that we put into our upfront due diligence is meant to help us avoid losses, help us maintain the right bad debt provision. So again, appreciate everyone's response here, and we'll continue this discussion.
Mhm.
Move us
Yep.
along.
Yeah, and consistent with what we were hearing, honestly, and that's why basically in 2020, one of the things that we made a priority here was to put a hyper focus on supporting cash management. That was definitely the number one thing, and the poll kind of confirms that for us. Collections and cash management. Cash continues to be king, and certainly monitoring what happens with it. So being able to assess back to those credit limits and assignments to assess real revenue exposure, not just in the order hold and credit release functionality, but the likelihood that that's actually going to be paid. What time delays do I expect in my cash because of delays in payment? Being able then to forecast and optimize that revenue appropriately so that we know where we can understand where the cash is at risk and how that comes into being. And then obviously back again to the reporting, which was operationally, the biggest challenge that we saw with a lot of our clients was defining, and coming up with consistent reporting that they could provide back to management on where cash was and how COVID specifically was actually impacting them. And so if we move to the next slide, one of the key drivers then that D&B started out with was curating alternate data sets that we could quickly drive to market so that we would have it. So one of the very first things that we did was we obtained all of the information we could from the federal government. Some of you, if you've looked at D&B reports recently, may have seen the new chapter that we have in the reports on federal information. We began tracking PPP loans. Who were they made to? And then we started evaluating the performance of those companies who received PPP loans. What did their delinquency rates look like compared to folks who hadn't received PPP loans? And that very quickly became part of our evaluation process and part of our scoring. Things like government contracts, who was being awarded those contracts, and then were those being slowed down or impacted because of COVID? That's also now a key part of the report. Shipping data, tracking again, what delays do we see and how does that impact a client's performance? If it's a key vendor and there's shipping delays, what's the impact to the overall business? And so we began capturing that. We've always had these components, but we put them in more quickly to the surface so that you could get your hands on that data as quickly as possible. Foot traffic was another key area for us, being able to see what was closed and what was open, and if it was open, at what levels of operation. Think about your favorite restaurants, and as they adapted to no dine-in but takeout. Well, obviously, foot traffic was impacted. How did that impact the overall strength of the business? Those were the things that we started taking a look at. And then also, because 2020 was not a challenge on its own with COVID enough, we also had the weather impacts. We had hurricanes, we had wildfires, we had a series of what in a normal year would have probably taken the headlines, series of weather impacts to businesses around the world. And so we had to adapt that and bring that into our scoring and into our data repositories as well, and get them where you could see them. And so that was a key thing for us. So being able to deliver this additional insight so that you could do that reporting, so that you could more quickly identify, even in the sales organization, who you could sell to and who you couldn't, that became key for us. So if you'll move to the next screen, one of the most common ways that we do, obviously, what we're known for, is coming up with consistent scorings. So this is a very easy way for us to segment all of the data points. There's over 2 billion pieces of data coming into our process on a consistent basis. Being able to take that data and put it into something that you could quickly use and adapt for your business. And so some of you may have seen our COVID impact index in most of our platforms. If you look today, you do have filters and fields available that identify businesses that have been impacted by COVID. That continues to be updated. And that is something that we have found a lot of clients have been able to take real use and benefit from being able to do that reporting on what businesses remain impacted. Also has a other benefit with the recovery index, because we do see some businesses that are now near operational pre-COVID, pre-March 2020, business back to business. And so that was another key one that we did, as well as the economic risk insight, because again, with the weather impacts, with the regulatory changes, with the COVID impacts, we realized that we needed to get more robust data to you at the macroeconomic level as well. So if we take a quick look, the real goal was to help identify with this new intelligence, then what is really high disruption, with limited recovery. So thinking about my cash management, then which of my businesses are in my portfolio are most impacted by what's going on right now with limited recourse or recovery. And by that, we mean that those clients that were already on shaky footing financially pre-COVID, pre-2020, probably were very negatively impacted. So you have to take a look at those two things together. Which ones were already on shaky footing on their own that then would not be able to withstand the changes and the disruptions that were taking place in the market. So that was the one key tranche of risk we wanted to start with. And then from there, which ones, could adapt. So again, thinking about our restaurants that were able to recover, not have dine in, but able to recover with takeout and to be able to sustain and to maintain during the period of 2020. And then what businesses, frankly, had low disruption, even as a result of COVID. You think about our online retailers in 2020 showed some pretty strong growth during that time period, where obviously physical retail locations did not. So for them, low dip from the disruption by, at their customer base, but perhaps some challenges with supplier in order to fulfill those goals. And so that's another area that we wanted to kind of break that risk in, is to segment for you what would be high disruption and what would be low, so we can do that. And so if we move then to the next slide to talk about the COVID impact index specifically, I just wanted to give you a quick breakdown on what components are in that. So obviously at the very beginning, so Q1, Q2, and again now, as we're starting to see other countries moving back into lockdown and stay-at-home orders, indoor masking requirements, et cetera, we're constantly monitoring that. So the location impact, where they're at, is a key component of the COVID score. The second one is the industry impact. So again, the foot traffic, using layoff data that we've seen, that obviously, again, is another data component that we've always tracked, but now we're bringing it up to the forefront in these scores so that you're able to use that data more effectively and more accurately. And then taking a look at things like job postings to see where new hires are being created and where they're not, where we're seeing changes in typical posting events. That's also a component of the score. And then last, and certainly not least, the individual's company's performance itself. So how do they look with our traditional predictive scores? That limited recovery, do they have the capacity to withstand a disrupted market? And taking a look then at our standard scores for delinquency, our credit score, our failure score, the viability rating, and our global business ranking, we combine those three elements together, then the COVID scores begin to have more impact. And again, as we said, majority of you have probably already been able to see that in your existing platforms. But if you haven't, do take a look at that because I think, again, I don't see reporting requests disappearing anytime soon. And as we move into this area now of potentially another wave of disruption, it's going to be important to have that data accessible to you for that reporting.
Hey, Rhonda, we did get a question. I figured we'd answer it real time here.
Sure.
So a question came in from time to time. Some of our potential clients are non-D&B net members, those that may not have a D&B number or score available. Do we have scores and business information on non-members? And if not, is this something we'll have available in the near or immediate future?
So we always keep a repository of companies. I mean, we have, again, 420 million in the system. And we do that, we start capturing it at the governmental level. So as a company registers with the government, that's when we begin to capture. We may not produce a full report until we have validated all of the components that we have necessary to create a report and to put it out into our standard systems. But we always have the ability to order an investigation. And so I would encourage you to do that if you have that situation where you have companies that don't that say they don't have a DUNS number. Honestly, they probably do, and they just don't know yet because of the way that we create our DUNS numbering. We just may not have issued a report on them yet. So ordering an investigation is the quickest way to get that done. But we do have, we call it our small business repository, where we capture data and hold it as we build out the reports until they're the level of information that we normally produce.
Yep. No, that's absolutely right. So yes, reinforcing what Rhonda said, encourage you to submit those investigations, and we can start to compile the additional information that may be needed to help you make your most informed decisions.
Mhm. And so, because I do want this, I think everyone has probably a little bit of COVID burnout. I know I do. But I do want to talk a little bit about the recovery index, because this is another key part of what we've been doing. And the way I like to think about it is this, as we come out, obviously, we're opening, there's some areas where offices are opening up again. There are some areas where we're starting to see some uptick. But it's not always as rapid as we like. And an example I give, I'll come back to our online retailers. Online retailers had a great 2020. And they're actually starting to see a little bit of a decline right now. If I'm guessing, it's probably due to the fact that a lot of people just want to go now out because they can and go to a physical store. But they are starting to see that decline. Food stores would be another one. When food stores in 2020, there was a dip. It was only about 16 points on a 1 to 100 scale. Personal care, manicures, pedicures, hair services. Now that took a 76-point decline. And even now, as people are starting to come back out of it, personal services still hasn't quite gotten back to where it was before. And that's why the recovery index becomes so important, because it's tracking how the industry obviously is responding, but then what type of activity are we seeing there? So are we seeing, for example, credit card usage at those locations? Are we seeing the ability to get out? So coming back again, thinking about, indoor mask mandates, things like that, regulatory requirements that are, coming back in at the local levels and the federal levels worldwide. So how are they actually handling the recovery aspect? And so that's another key component that we think, as you go through it, you'll want to take a look at and be mindful of. And then the last leg of that stool was the country level economic insight. So again, 2020 being the year that it was, folks that did have to broaden their horizons and take a look at perhaps expanding sales into other markets where maybe they hadn't been before, or where folks were in certain countries but needed to expand into other countries. It became really apparent that keeping track of, for example, just in Western Europe, who was closed, what countries, what borders were closed, what borders were opened. So we had to do something on the economic insight as well, because what we were seeing was there were short-term, obviously from a credit and finance perspective, I've always got to keep my short-term economic outlook in mind. I've always got to keep my long-term potential in mind. I've got to keep track of foreign exchange rates, transfer risk, business continuity. On my supply side, for folks that are evaluating suppliers as well, now I've got to also include my political and insecurity risk. So, last year, especially around Q3, Venezuela was a real hotspot for insecurity. So back again to my reporting, how many accounts did I have in Venezuela became, a key talking point for a lot of suppliers. And then again, the business continuity, are they still going to be there? A lot of companies that we work with, they have established supplier relationships, 18-month, 24-month contracts. Those aren't just, buying widgets and then walking away. And so being able to see what the long-term outlook for the business became very important to them. And on the finance side as well, on the credit side specifically, if I'm selling something on 30-day terms or 60-day terms and counting an FX and counting it, and now I've got a closed border where they can't sell their goods out because they're on lockdown. What allowances do I make for that? And so that's one of the things that we had to start really focusing on, was what did we do for economic insight as well. And so now in your reports, as you use your tools in all of our platforms, we have included a country level risk rating in all of the reports, so that you'll be able to see at a glance what that looks like and how that impacts the business itself as you're evaluating. And then the last thing that we worked on as far as a score component was in our collections prioritization score. And so again, one of the key things that we had, out of last year, and it has not abated at all in 2021, is how quickly can I get my cash back in the door on my accounts receivable portfolio. And so what we did was we came up with a new collections prioritization score that would take our traditional scores, but basically enhance them to where it really focused just on collections. Collections is different than a standard evaluation. When I'm doing an evaluation, I'm looking at the strength and stability of a company, historical performance. But collections, I need to know real time. What's their cash situation? Can they pay me?
Yeah, and to that point, Rhonda, I think that highlights, what I've always spoken about, which is you have your upfront due diligence, but then inevitably, because I don't think we're all lucky enough to be in a position to say no to an opportunity. So if we assume that to be the case, the next step is, how do I properly segment my portfolio? But within that risk segmentation, how do I pursue debtors? And more importantly, how do I proactively pursue those that have the greatest potential for falling delinquent? I think it's what I've called an anticipatory approach versus a reactive approach. Look, if a collector's making a phone call because someone falls one day beyond 30 past due, that's completely reactive. There's nothing
Mhm.
you're doing that's proactive in that scenario. But the scores that are being developed, it's a matter of identify the attributes, formulate the score, but then our obligation to our clients and new businesses out there is to help them understand what's the practical application of the score. So I think, Rhonda, you hit it on the head. And as a former practitioner, what are we
Mhm.
doing with that CPS? It's great that we have the score, but maybe give, a real example as to the application of that score in a collection strategy. And
Oh,
then
sure.
a question. So let's get your answer, and then I'm going to ask a
Mhm.
question because it's piggybacking off the previous question we had.
Yeah, absolutely. I mean, I think for me, the thing is, if I'm reactive, if I'm just waiting until I see something show up in the over 30 days before I'm making that initial call, I'm technically already 60 days behind the risk, right? Because I've already done the sale, I've already waited 30 days. Um, so I'm already behind and I'm already losing money. If I have, though, the prioritization score in place, then what I'm able to do is I'm able to put my resources, so my people resources, my system resources, to tracking the right dollar, where I'm going to get the most return quickest, get the bang for my buck. If I've got, let's say, someone that I've got two companies, both owe me $1,000, but one company is on shaky ground and may not be here 120 days from now. I want my best collectors on the phone with them now to get that money, because they may not be there 120 days from now to get it. Conversely, if I've got $1,000, out to a customer who's fairly good standing, well, then maybe I give him that courtesy phone call, 10 days, or a courtesy email, and then follow up with a phone call. I might be willing to wait another 30 for him. But that's what the prioritization score does for me, is it lets me pick and choose basically based on my rules and what my threshold for risk is as a credit manager, what I can afford and what gets me the most money in the door fastest. And back again to reporting, because I'm never going to get away from reporting to management. Now I've got something that makes my cash forecast make a little more sense, because I'm able to show and quantify how I prioritize the collections.
Yeah, no, great, thank you. So the question piggybacking off the last, so for those, we'll call them non-D&B members, or those where, we've got clients who are onboarding new businesses, does D&B provide provisional assessments with risk warnings? And the impetus for the question is because this particular individual is asking because their specific business model, integrated marketing and communications, includes providing strategic and tactical counsel for one-time or one-off projects such as crisis or issues management campaigns. Oftentimes, these projects come from new cos, essentially startups with venture capital funding.
Yep.
I venture that the answer is the same in that, if there isn't a report readily available, certainly submission of an investigation. But as we formulate or as we create the file on that business, we provide the standard risk attributes, meaning the risk analytics that would be found in any comprehensive report or one of our more robust reports. Is that accurate?
Yep, it's accurate. And then we also do for nascent companies, for companies that are in business less than a year, for example, we also provide specific data attributes so that you can see in an automated fashion. So let's say that you've got a file coming from D&B, for example, that's fed directly into your collections processes. We actually create flags that let you know it's a nascent company, that it may have potential issues, and we bring that in as well. And we also highlight and find the owners, because one of the things that SBA pointed out a couple of years ago, and it's still valid, once a company starts a business, once an individual starts a business, starts a small business, they don't stop with the one. If they're a small business owner, they'll end up with 3 to 5 businesses in their lifetime. And so it becomes really important for us at D&B, and this is actually a great segue to what I wanted to talk about next, is tracking people through their business entities, because even if they're a brand new startup, that owner has been in that business before, and they're starting a new company to be in that business. And so we actually have in our database repositories a way to track and identify principals through these businesses as well. And so to your question, Chris, we will probably have something at least on the principal identification as well, as a component. But with the network intelligence, one of the things that we have, and thank you for jumping ahead on that, those 420 million businesses have over, and now this is actually slightly outdated because it's a month old, and we're actually already over 265 million resolved entity profiles. And so what we're looking for here in this additional data is we're trying to get back to that know your customer. It's not enough to know the business and to pull a D&B report and say, oh, they're a 5A1, so let's give them an initial credit value. It has to be more than that now from an evaluation standpoint, because again, cash flow, cash is king. Got to be sure it's going to be paid. So what we've done, if you'll move on to that next slide, is we've moved towards identifying our owners, our people related people as they relate to businesses to a DUNS number. And so this is part of our expanded customer due diligence offerings, so that we know exactly who you're doing business with, because that obviously is going to have a material impact on your cash flow as well. I have one client that I've worked with here in Texas that had the same entity at the same physical location, changed the company name 10 times in a 6-year period. But because of the D&B information, they were able to pretty quickly ascertain in a fraud investigation, that it was actually the same owner. That was just, changing the DBA, trying to apply for credit, getting initial credit terms, and then, obviously being shut down. So it's that kind of thing that we're looking for, making sure that we've mapped exactly all of the business entities, and hopefully saving you some time as you are making these evaluations and making your credit assessments and your supplier assessments. Because if we're tracking the individuals, then you don't have to go searching through the legal filings to look for related entities and names, because we're going to give you that already. And if you've seen in our history and operations sections of our reports, especially in the last year, we've really expanded the amount of affiliate information and owner information in those reports as well. And if you'll move down to the next slide, you can really see it come through with the business ownership and the beneficial ownership. So again, just making sure that we track that intelligence and that we properly identify who they are, where they came from, and what their information is. Because when we look at cash flow, and I'll just have you jump to that next slide. I'm coming from a credit practitioner background. My job was collections and cash flow, but it was also a component of evaluating the suppliers as well, and making sure that we weren't losing money there. And so one of the things that we're seeing now, especially as we talk to folks that are responsible for managing supplier risk, is that, we have the most compelling one. Over 70% of the folks that we talk to on a regular basis are telling us that they're really worried about supply disruption and how that's going to impact them through this year as well. Now, that obviously has a cash flow impact to us. So one of the other things that we've done now, if you'll move to that next slide, is we've also added a light. Let's just go to the next question first, because I am interested in the poll.
So yeah, where is this risk evaluation for suppliers performed? So in some organizations I've worked for, it was done by the credit group. Other organizations have separate procurement groups. It could have been the accounts payable team or other. So if those that care to participate, please respond. But I think, this is an opportunity to also bring up again the fact that whether it's customer onboarding or supplier onboarding, what we're seeing is an overlap where we have credit and finance professionals looking for information that would have been traditionally found in the supplier onboarding exercise, and vice versa. We have now those responsible for supplier onboarding looking for the level of financial due diligence you would have found if you were performing a customer onboarding exercise. So let's see, we've got, looks like credit and procurement. I think that, 30, it's pretty much a third, where we've got some where that's still done in credit, some it's done in procurement, and then 27% is done in both credit and procurement, with a low percentage and a low number of respondents in the other category. So I think the makeup of your organization may dictate the flow itself, where if you have a separate credit group from a procurement group. But I can see where, again, the both comes into play because of this overlap that we're finding in the need for more analytics, more information, and less of a distinction between customer and supplier, and more, what are my business interactions and what risk is out there relative to those business interactions, not so much customer versus supplier, but overall relationships.
Mm-hmm. Yeah, and I think, back again to finance operations, right? And the reality is we have to track every dollar, no matter which side of the ledger it falls on, and the risk evaluations become key. And so that's why, and I'll wrap my section with this, but I do want to point out one of the other things that we've done to make it more accessible for our folks that are perhaps using our credit reports to see this, is we've also put in a light restricted party screening view as well. So if someone has been debarred, if there is something on the report that is a concern, you're going to see that now as well within the report under that federal information. So we've rolled it out here for the US first, but do take a look at that. And of course, there are expanded offerings as well for our supply folks, but just wanted to make sure that you are aware that that data element is now available in the reports as well.
Yeah, before I jump into my section, Rhonda, we did have one other question. The question, well, it's a comment in question. This individual is commenting that they don't see a count measure of companies that contribute to the Paydex score or other scores. Can that be reported to or reported on? I interpret that question as wanting to know the number of trade file contributors
Mhm.
that essentially may help derive a Paydex score or make up that
Sure.
score, any of the other scores. So
Mhm. It is
maybe,
like it's a data element that we offer. It's a common data element. You'll be able to find it in the detailed trade insight section of your report. There's a number count, and it's I believe the data field is called total number pay experiences. But that's available in our reports, and it's also available in all of our standard data packet offerings.
great.
Mhm.
Thank you for that.
Of course.
Thanks, Rhonda, for sharing all your insights on analytics. We're going to jump into a section that's now focused on really essentially the software we have now available. So we talked extensively about the analytics, new analytics, considerations. I'll share some stats here, but essentially what we want to cover now is the D&B ecosystem, where we're very well known for our credit discipline and our domain expertise, but we realize that it's not enough to just report numbers and statistics and analytics, but also being in a position to effectively help organizations manage the end-to-end credit to cash cycle. So still this should resonate with those that are still with us. We still have a tremendous amount of work to do in managing customer data, likely data overall. Um, we know that there's disruption that has been realized and will continue with regard to COVID. These percentages are reflective of that. Uh, I found this to be an interesting statistic, based on a survey that D&B conducted of 1,200 finance leaders, where 42% of the respondents plan to purchase new or enhance existing technologies. I think there's a recognition now in light of COVID that we can't just rely on our people resources, and we need to arm them with solutions that are going to assume the administrative burden so that those resources can focus on the value add activities. And because let's face it, we just, as cost centers, and most of us operate as a cost center, we just don't have the luxury to continue hiring and bringing on new resources. So, in turn, we've got to figure out a way to maximize our systems and our technology. And then, you know, although 28% is a relatively high number as far as companies stating that they have completely automated credit to cash, I'd probably push back a little. More importantly, this tells me that 72% haven't. So there's a significant opportunity out there, and I think based on the 42% that plan to purchase new or enhance existing technologies, there's a desire to do that as well. So we'll speak to some of this with the few minutes we have. Won't spend a lot of time here. What the objective of D&B's Finance Analytics, which again is a combination of our credit intelligence and receivables intelligence, what we're really trying to do beyond just creating and deriving new analytics, we really want to increase business intelligence. We want to make sure that what we're creating and providing results in actionable outcomes, because that's where we help organizations realize their resource optimization. Again, move the administrative burden to the technology, free up your resources for more value added activities, increase cash flow. Cash is king. Working capital improvement, overall cash flow improvement. And this is an interesting one that I've really focused on lately customer experience, knowing in the day of COVID, we've got businesses where people are working remotely. Your interactions are typically electronic over email. We see an emergence of customer portals where businesses are moving from a conventional transactional experience to what I'm calling digital experience, where, for those low touch, low risk, low dollar accounts, how do we bring them to a portal experience where they can self serve? Well, the only way you get there is by introducing a certain amount of automation in all of the preceding, activities that are part of this very robust credit to cash workflow that we work within. And so I'll spend a couple of minutes on this slide because I think it really brings together this idea that, D&B still has a strong hold on the credit process that many organizations are initiating for their customer onboarding, for their portfolio management. But as I said, inevitably, we're all here to increase revenue, make money. We don't always have the luxury of, saying no to an opportunity. You've all been in the seat of getting a call from a sales rep, and all they do is escalate to the next senior leader who says, we're willing to take the risk. I say our due diligence as credit and finance risk professionals is done when we've made our recommendation. If the business wants to make a decision to proceed with an opportunity we deem too risky, that's just it. It's a business decision. So now our obligation becomes portfolio management. How do I ensure that as I track those deals, I'm in a position to better anticipate risk, report against that risk, and collect it? And then, to some degree, we get to say, told you so, but we start to see behavioral patterns coming out of this collection management work stream that we can apply to updating our policies, updating procedures. And if we go left to right, these are all the things that D&B is invested in. These are the things that are on our strategic vision plans. We're going to continue going down the path of creating new analytics from alternative information. We're going to look to apply those analytics into our receivables intelligence platform. It is a software solution. It's an enterprise middleware solution that now introduces the ability to create the workflows that are necessary to really take advantage. As a former D&B client, I loved that D&B was always ahead of the curve, introducing new analytics. I always ask the question, however, how do I make practical use of this? How do I take the alternative information like ESG data, fraud data, new global business ranking data, overall business ranking data? It's good information, but what do I do with it? And receivables intelligence is what allows our clients to take advantage of these analytics, of the predictive scores, the new scores that we're introducing, and establish that meaningful workflow that lets your people resources focus on value-added activities. Let's get to the reconciling items. Let's start resolving disputes. Let's enhance reporting. Let's be part of the strategic business decisions that are being made by the CFO, by the CEO. And I think, again, not to belabor the point around COVID, but it has served as an impetus for why the credit and financial risk professional is getting a seat at that strategic table. And we've got to keep reinforcing it. But in order to do that, you have to introduce a level of automation to increase operational efficiency, optimize your resources, and really create the output that allows businesses to take action, not simply just be there for informational purposes, but actually guide strategic decision-making initiatives. So again, we've spoken about some of this. We continue. We're not abandoning what we've grown up on, which is robust credit decisioning, credit onboarding, portfolio management. We will continue to leverage our analytics. We want to help businesses increase operational efficiency, and through new analytics, we're deriving new business insights, enhancing existing business insights. And I see an additional question. Can we show an actual report with the new data visible? We're not going to have that in today's webinar, but we can provide. We're going to talk about our IQ report at the end of this discussion, which is going to be wrapping up here in a couple of minutes. That may help highlight some of that. We can talk, and I'll defer to Rhonda on ways that we could make some of these new analytics visible
Mhm.
to you. But just a couple of slides, if you'll bear with me. We'll leave a few minutes for Rhonda to speak to that in our IQ report. Let me get ahead here. Um, Look, all of this is very repetitive. Obviously, every organization is looking to improve cash flow, increase operational efficiency, increase and enhance those business insights. We know that we can deliver that through our finance analytics offerings, credit intelligence, receivables intelligence. Why? These are real results. This is what clients who use our solutions in a unified, comprehensive, end to end process, we've delivered these results. DSO improvement, bad debt reduction, really, I think the operational cost reduction and automation are huge areas of opportunity. Look, DSO reduction is important. It's representative of what you're doing to help increase working capital and cash flow. What I will say regarding DSO is typically what I've found is that to ensure sustainable DSO reduction, you really almost have to look outside of the collection discipline. I found that the biggest contributors to increased DSO are things like errors on the front end, whether they be billing errors, delivery errors, issues that arise, the whole dispute management process, deduction management comes into play. And quite honestly, on the back end, where you may be getting paid by customers, but they're not providing remittance. You're having to reconcile over days to get that money accurately applied to an account, to an invoice. It's very rare that I found any inherent financial instability within a portfolio because that comes up very quickly. You know who's not paying you and you address it. It's these other activities that are occurring because collections becomes a bit of a dumping ground, if you will, for issues. Now is the opportunity for us to take that information through solutions like receivables intelligence, automate the identification, validation, and adjudication of those issues, get that workflow pushed out to those other operational owners. And I guarantee, because I've realized this as a practitioner, you will begin to see reduction in DSO. So my focus here has always been on reducing operating costs, but then also increased automation, which delivered operational efficiency. But these are the results of what we've delivered for clients that are using our finance analytics solutions. And then what are we looking forward to? We're going to continue streamlining our platforms. We are very much dedicated to creating a user experience that, again, is unified, that doesn't feel like you're working between modules, but rather being guided through a user experience where everything is available to you in product, in your use cases. Flexible solutions. So, I talked about conventional to digital. We go from digital to mobile. So these are things that, again, as the head of product for finance analytics, I can attest to the investments in both money, time, resources that we're making to enhance our solutions. And then we'll continue building on our AI driven intelligence. Not only that, with the introduction of receivables intelligence, now we have an AI platform that also incorporates machine learning, intuitive learning, behavioral learning into the workflows. And I think that's where we're going to start to deliver real operational efficiency for our clients. So, with that being said, and just a few minutes left here, I'd encourage everyone, Rhonda, let me defer
Mhm.
to you. You can articulate this point and bring us home.
Absolutely. So the one thing we do want to make sure of, if you haven't already had your IQ report service done for you this year, that this is a complimentary service that all of our clients receive to do an analysis of your current AR portfolio and how they basically perform under today's current market environment. There is no charge for that. So we do want to make sure that if you haven't had that done, that you take advantage of that. Also gives you a great way to take a look at how our traditional scores and these new data sets will work within your business, so that you can use those. And for the question on the credit reports, we do have a sample credit report that we can make available to you. So when you do receive your IQ, we'll make sure to put that in the system so that you can see those new reports directly with that as well.
The last question we had, and it'll bring us to the top of the hour. If you have finance analytics, do you automatically have access to the receivables intelligence platform? The short answer is no. But what I will say is, as a finance analytics client, if you're using account manager, decision maker, OCA, or portfolio risk insights, we can make the connection of the data of your portfolio that you're submitting for use within our finance analytics product suite. Again, account manager, decision maker, and such. It makes it easier to transfer the data from those solutions into the receivables intelligence platform. This is D&B's what I know to be the first foray into software. So where the other offerings are really providing the content, now we'd be introducing an actual software application. It is a SaaS-based solution, web-based application that is part of the suite of finance analytics offerings. If interested, certainly, reach out to me directly or reach out to your account manager. But it's not available in the sense that it's not just yet another module per se that would pop up in your finance analytics view, because it is a software that would require additional discussions, a scoping exercise, and it is modular. We didn't go through that. It does contain 3 distinct modules, but in a unified software application. We have our collection management module, cash management module, and our customer portal. While we encourage clients to look at those modules collectively to get the biggest benefit, it is a modular solution in that if your appetite was only to address any collection challenges, we could introduce you to the collections module separate from the others, and we can work with you to build on that iteratively. And to that point, you don't need to be a finance analytics customer. While we would encourage you to at least have account manager, it's not a prerequisite to introducing the platform to you, that the receivables intelligence platform. So I may have time for one more question. It was just a comment. Thank you for the comment. Excellent job on this. Very much appreciated. Real quick, I want to thank Rhonda for participating in this session. I want to thank our marketing team who works tirelessly to put the content together to get us all set up. It's easy to deliver the information, very tough to get it set up. And most importantly, want to thank all of you for attending. Obviously, we need your feedback to ensure that, what we're creating is meaningful, usable, and resonates. I wish everyone a safe, happy, healthy rest of the work week. Please reach out to your account managers. You can reach out to us directly if you have questions about any of the products and solutions we've discussed. We will send out a copy of this deck. I'll ensure that we put mine and Rhonda's contact information in, as I realized we didn't have that readily available. But as we're at the top of the hour, thank you all so much. And again, have a great rest of the day.